Welcome to the Wealth Under Pressure podcast. Financial success very often has less to do with owning a financial product, earning a high income, or even being frugal. Instead, the path to success comes from having a comprehensive plan that enables you to optimize decisions and avoid mistakes. Join John Smallwood, a certified financial planner, as he identifies key areas of pressure on people's wealth and strategizes to reduce it. It's time to liberate your wealth.
Hello and welcome to episode number 10 with John Smallwood. Now, this is a special episode because John and his team just came out with the 2018 Small Business Owner Guide to maximizing your benefits from the 2017 tax cuts. Now, this is not your normal podcast because John is going to take you through 8 steps that are actionable steps that you can take immediately to be able to maximize your benefits from this. So, John, welcome to the show.
I appreciate it, Matt. Thank you. Well, it's good to be here.
I am so excited about you walking through this paper. Now, you are the author of this paper, and this came from you. Now, if people have been listening to your podcast before, they know how passionate you are and how excited you are about the opportunities that this new tax law has given us, especially for small business owners. So let's just start jumping right into this. Go for it.
So we started in December when we figured out what was happening, and it was wide open and a lot of stuff you don't even know what's going on. And as we kept digging into this, we thought what we would do is we do a 2-3 page guide, and we would kind of just give people some guidance as to what's going on. And as we dug deeper into it in the conversations we had with clients, we realized people don't really understand what this new tax law means to them. They don't understand the potential of it. And what we wanted to do was basically do something completely different and give you 8 real meaningful steps to take that the guide, if you download the guide and you print it out and you sit down and you review the guide, we built it so it's like a workbook. So you can actually start taking action and see what it means in your financial strategy. Most guides that I've downloaded off the internet are, it's fluff.
Right.
All right. And I didn't want to do that. I want to give the listener, give the user, give the downloader the opportunity to actually walk away with real content, take it, implement it with your own tax advice, with your own people. I'd like you to work with us, but there's no obligation. And that's the way we've always brought our business around, is that let us give you the value. This is a demonstration of the value that we can create for a client, and let us go beyond this. And if we add value, we'd like to work with you. If we don't add value, then I don't deserve to.
Sure.
All right. So what we thought as we went through this is that it's so powerful that if you do this in a sequential order, which is, I went through step 1. I'm just going to walk through this. There's so many different changes and so many provisions, so many nuances. It's being rewritten as we speak. It's going to change, but I kind of pulled out what I believe to be the key provisions, which we'll walk through. So step 1 is, what are those key provisions? Step 2 is, how did my personal tax return work in 2016 and in 2017? And I have a chart that we're going to walk through, which is, you need to understand your key numbers before you can make any decisions going forward. I see people make decisions every single day without understanding where they are. Oh, I want to do that. That sounds great, right? And they go off on a tangent, and it really has no impact on them. Identify if you have the qualified business income deduction. Are you going to be a candidate for that? And what impact is that going to have? And then once you understand whether or not you have QBI, step 4 is apply the 2018 tax rules. See how it shakes out. Then review your entity. You're a sole proprietor, you're a C Corp, you're an S Corp, you're an LLC, you're a partnership. Do you have the best format of an entity for your individual business? Meaning, did I get the best asset protection, and did I get the best tax treatment? That's really the 2 benefits, right?
Right. Absolutely.
Right. And then now that we have this much higher standard deduction, and we have this SALT deduction, this limit on our state and local income taxes, my itemized deductions, I need to really make sure that I'm optimizing those to get the biggest bang that I can for those dollars. If not, I need to change the way I'm thinking. Then you need to look at, because this tax law is so reduced for the business owner, you really need to think through tax deferral. All right, and we'll walk through that. And then what I came up with is that since this tax benefit is so important, we want to focus on business growth. And I put together 4 factors to 25% profit growth. It's pretty simplistic, but it's something that we all should be focused on every single day in our businesses, because the whole reason that we're business owners is to, we have our product, the thing that we give out to the world, which is this wonderful value. But in turn, we want to create wealth for ourselves, and we want to get the biggest bang for our dollar with our marketing dollars and the time that we spend here. Not unlike anybody else in the world, whether you work for a corporation, it's the same goals, right? So, we sat down and we started to think through this, and I basically wanted people to understand that in the new tax law, there's a dramatic rate reduction, meaning in some instances, when you look at the top bracket from 39.6 to 37%, and on the face of that, you look at it and say, okay, it's a 2.6 to 3% reduction in the bracket. But because of where you hit the top bracket, meaning I don't hit the top bracket at 600,000, and on the old tax law, I hit it at 470,000. But when you start looking at itemized deductions, there can be as big as a 9 to 10% gap in that bracket because of where your business deductions and your itemized deductions are falling. It's really powerful. And then what we start to look at is the elimination of the personal and dependent deduction that is gone. The standard deduction is either $24,000 for a married filing joint, or you're going to take $10,000 plus mortgage interest, plus charitable contributions, plus medical expenses. So understanding what those are in your current plan is really important. The limitation of the SALT deduction, I feel like I've said SALT more in my life in the last month and a half than I've ever had.
Yes, I would agree. I've heard that more times than I could count. And
I never knew that term before December 15th. I know it was state and local income taxes, but it was never referred to as SALT. Mm-hmm. In my world, and I've been doing this for 27 years, so you learn something new every day, right? And the benefit of the qualified business deduction. Number 7, the mortgage interest and home equity line interest deductions have changed. There's some big changes in there, and there's a lot of opinions rolling around. So we know what opinions are like, but we want to understand how your mortgage interest is being deducted, whether it's home equity line or mortgage, and you want to take a very good approach on that in light of rising interest rates, in light of this new home interest deduction. And then the AMT, the alternative minimum tax, has dramatic changes to it. So, the guide walks through what these changes are. And the guide is available, by the way, for download on our website, smallwoodwealth.com. And you'll see the guide, and you click the button, you put your name, your email address, and we send it to you. And there it is. So what we started doing is, and I don't want this to be super detailed, but what I wanted to focus on is that I think most people are going to be able to capture $20,000, $30,000, $40,000 a year in tax savings, if not more. And it may only be till the sunset provision or, the next election when somebody else becomes president and they roll back everything. But you have to understand how these changes are going to work, how they worked in 2017 and how they would work in the new tax law. And if they change the tax law again, which if I was a betting man, I might bet that that's going to happen downstream. But how will they work then? Assuming they go back and revert back to the old tax law, which they may not revert back exactly the same way. But anyway, so in the second section, what we're talking about is being clear on the 2016 key numbers. And what I put together a list, and it's like a checklist. So what was your W-2 salary? What was your business income, either line 12 or line 17 on the tax return? What was your total retirement plan deduction for you? What was your self-employment tax? What was your FICA tax? What was your state income tax? What was your real estate tax? What was your mortgage interest deduction? Did you get home equity line of interest deduction? So then your total deductions, then how much your deductions got phased out. and then your tax on line 44 of your tax return, and then your AMT on 45, and then your total tax on 47. Then I think about this in three separate ways, which I believe is a really important piece, is that you have your effective tax bracket. So you make $100,000 and you pay $20,000 in those taxes. Your effective bracket is a 20% tax. What your marginal bracket is, where are your last dollars being taxed? Okay. So what you have is with this marginal bracket is the deductions actually occur where your last dollars are being taxed. So if you're in a 33% marginal bracket, but your effective bracket is 20%, the deductions are happening in the 33% tax bracket. And that's, the guy gets into the deep side of this. But a lot of things, like when you look at the income and you say, okay, I'm a self-employed person and I pay myself a salary and then I get a lot of deductions and things bring my income down. So my total income to tax ratio is what did I receive that I didn't pay taxes on to the total income tax. And that's a different tax bracket as well. So this section of the guide is really designed to focus laser in on the key changes and make a distinction. And I'm saying put in your 16 because pretty much everybody listening to this should have their 2016 tax returns filed, okay? And they're getting ready to file their 2017 tax return. So it's a great opportunity to pull out the 16, gather your 17 information, and as your CPA begins to do it, take note of what these things are. And then we want to basically start focusing on how do we get ready for 18? Because 18 is, it's February, 16th?
Yep.
When we're recording this, I mean, the year is moving. Okay. Now, my thought pattern on this is that if this law creates a $30,000 reduction in taxes owed, and it lasts for 7 years, and you found a way to say that was $30,000 that I was giving to the wonderful United States government, and now I'm giving it to myself. So when I gave it in excess taxes, not only did I lose that capital, I've lost the future value of that capital. Now I have this tremendous opportunity to recapture $30,000 per year, if not more, maybe less, for the next 7 years until the sunset, or sooner, right? But let's say that, for example, I've got this $30,000 for the next 7 years at 5%. That would create over $244,000 of additional capital that would have been transferred to the financial institutions, as we discussed in the last podcast, right?
Wow.
So let's assume that the sunset happens, right? And now I have that money sitting aside in a side account. Let's label the account, the tax recapture, the 2017 TCA, tax recapture account. Okay. And I put the money in there and it makes 5%. And 7 years later, the tax law reverts and I don't have the tax savings at this point anymore. So now I let it sit for the next 20 years. At 5%, the potential of that wealth is $648,000. What's the impact that could make on your retirement plan? Educating your kids, paying off debt, giving to charity. This is an amazing opportunity.
That is a lot of money compounded.
It's a lot of money. And if you're smart and we can put it in something that is tax advantage without taxation, growing that taxation and get some tax advantage income out of it, that might be pretty interesting.
Mm-hmm.
Those products still exist. They're still out there. So the quick summary on the QBI, as we talked about in previous issues, it's qualified business income. There are basically accounting, actuary, athletics, brokerage services, consulting, financial, healthcare, investment management, law, partnership interests, performing arts, and that my favorite one, any business or trade whose principal asset is the reputation or skill of one or more of its key employees is also excluded.
I love that.
I love that.
John, I think we need to print up shirts for that and start distributing those. That's my favorite job description ever.
Every one of my business owners, my clients, they're stars in their business. There's a star in that business that creates all the relationships, brings in all the revenue. Like, how do you quantify that? So we'll see how they enforce it and how that plays out. But I think the key distinction in this QBI is that if your income is below $315,000, your adjusted gross income is below the 315, and you're one of those excluded businesses, you're still going to get the 20% qualified business income deduction. And I think that's what people don't understand. They think, oh, I'm an accountant or I'm an attorney or I'm a financial advisor or I'm a consultant of some sort and I can't get it. You do get it because your income is below 315. And from 315 to 415, it begins to phase out. It's 1% for every $1,000 over or something like that. I forget. We have it in the guide, but it's one of those complex calculations. When you cross above that $415,000 number, now you're coming into that calculation, which is I'm either, if I qualify, if my business is not excluded from that list, I'm now going to get to 20% qualified business income or the lesser of 50% of total W-2 wages paid by the business or the sum of 25% of the W-2 wages plus 2.5% of the adjusted basis of assets of the corporation. Very complex calculations. I think everybody's accounting costs are going to go up dramatically. I was with my accountant the other day, and we were laughing about it and joking about it. And I said, "It's the greatest opportunity." He goes, "I wish I was younger because this is amazing. This is just everybody's got to rethink everything, and you can't." He mentioned in the '86 tax law that the passive activity took 3 years to figure out to get a clear guidance from the IRS on how that was supposed to be treated. I mean, so he said, you have to go cautiously, but this QBI, you have to know what your business looks like right now. Then, okay, so now step 4, we figured out, we know what your 16 and 17 tax liability was. We know what your mortgage interest, kind of know how you sit, how you look. And I created an example in the guide of, we've got a Schedule C guy making $400,000. We've got an owner of an S corp with a $100,000 salary and $300,000 a year in distributions. And we walked through the tax difference between the Schedule C versus the S corp, and then how it works in the 2018 numbers. And what we're seeing is somewhere between. This is almost somewhere between a $16,000 to $30,000 savings in that income bracket, which is a high income bracket. A lot of small business owners don't do over $400,000. A lot do, but the majority do under that. So you start thinking about a small business owner, the mom and pop shop, the accountant, the attorney, doing $400,000 a year or less, net after business expenses. That's powerful. We're talking about a substantial savings for the individual based upon this 2018 tax law. I'm showing it in the guide at almost $23,000 for the $400,000 a year person. So I'm pretty excited by that.
So let's talk about the excitement, because you have some stuff coming down the pipeline here that will allow people to absorb more of this information and get more of your thought leadership. Do you mind talking about that a little bit?
Right. So what we thought is, one, download the guide and read the guide. And if you can't sleep after you download the guide, if you're having trouble sleeping, go downstairs, grab the guide, read it again, you'll be sleeping. I'm just kidding. But what we're doing is we're putting together a webinar, 1 to 2 webinars per week, starting in the last week of February. And we're going to be rolling those webinars on, for the next 3, 4, 5 months. We don't really have a time frame set on it, but based upon people's interest in what's happening, we'll do more and more of those. We're also offering, as we always do, part of our offer is before we meet with you, before we talk to you, we have a 30-minute, what we call a wealth curve conversation, which this is a conversation where we want to get to know you, you want to get to know us, and we kind of want to walk you through some questions to understand where you are, what's happening, how can we help you, and we can really put you on the right track in that conversation. And in that conversation, what we say, we find out about your family and your income and your business partners and your deductions and your future liabilities and the way your assets are being balanced and how they're being protected. And in that call, most people who do the call walk away with 5, if not more, concrete ideas to implement in their financial plan. And there's no obligation to go forward. There's no fee for it. There's no cost for it. What we want to do is we want to spend some time getting to know you, and you want to really get to know us to make sure that we're the right fit. Because what we're interested in is spending, the next 20 years with you, building your financial plan, reviewing your financial plan, updating your financial plan, making sure that it's protected properly, making sure that you have the right tax benefits, making sure you have the right allocations, making sure that your business is being optimized. All those things are really important. And that's what we're trying to do. So the webinar to the introductory call, and if you want to move forward, we'll do a complete review of not only your how this QBI is going to work in your plan, but we'll also look at your entire financial strategy and make sure that the asset protection, the wills and the trust, all the things that we do in a normal financial plan are being done and being done properly. So there's a lot of resources that we're putting out here, and we'll probably be doing more podcasts on this in smaller impromptu venues. We might actually do a seminar also. If we get enough people on the webinars and things like that, we might take a day and do a day-long seminar, bring in the accountants, bring in the attorneys, talk about the asset protection, talk about all those things.
Okay.
This is so new and such a tremendous issue that we're just trying to figure out what people really want and how and the format that they want to do it in. But so once you understand the impact of potentially how your 2018 taxes are going to look based upon the same results that you have in the business, now I think you should really review your entity. And what we did in the guide is we gave you a great summary of the different types of entities that exist so that you're looking at this sole proprietorship, an LLC, an S corporation, a C corporation, a partnership. So really giving you the pros and cons of all those types of entities. And it's a perfect opportunity to really look, to rethink your business and make sure that it's the right structure. And my focus always on the business structure is asset protection first. It's second, it's the income tax benefit to it. And it's also the continuity of how I can pass this business off to either my family or my partners in the buy-sell agreements. And this is one of these opportunities. Also, most businesses that I encounter don't really have a good buy-sell business continuation strategy.
So, John, if they are interested in coming to a webinar, coming to an event, downloading the white paper, they just go to the website, right? Can you give them the website again?
SmallwoodAssociates.com.
And that will also get them an opportunity to sign up for, I'm assuming, some sort of a mailing list. So when you come out with new information or you are doing stuff, you can keep those people posted on that. Is that correct?
Correct. When you download the guide, you're automatically going to be on our mailing list. And on the first email that we send you with the guide, if you don't want to be, you can opt out of our mailing list.
Oh, that's nice of you. Thank you for that. Yeah.
Okay. And in addition, on the website, if you wanted to skip the webinar, you wanted to skip everything, there's a button that says schedule an appointment. You can call the front desk. Ellen will get you scheduled for that 30-minute conversation.
Oh.
Or you can do it right online, pick a date that works for you, and it goes right on our calendar. And we've set aside, Ed and I have set aside about 3 to 4 meetings a week that are set on our calendars for this type of activity so that in the calendar you can schedule out as far out as you want to go, but we want to make sure that we have enough available. And if we need to put more in, we're going to do that. But what we wanted to do is make it available that you want to jump right to the 30-minute call, be our guest.
Mm-hmm.
So that's available there. The thing that's really interesting to me, in step 6 of the guide, we go through the mortgage question and we show some great examples. And what's interesting is when you download the guide, optimizing your mortgage interest deduction has always been an important part of a good financial strategy.
Mm-hmm.
It's the most important part of a financial strategy that I can see. That itemized deduction, interest paid, has now become extremely important. And how do you maximize it for the next 7 years and beyond? Because I think it's always been important. But if you think about it, if you stop and think for a second, we are still at 40 around 40-year lows in the interest rate environment. Despite the loans maybe being at 4.5% now, and they were 3.5, we're still at these interest rate lows. And now is the time to lock in interest rates. I mean, a lot of these things, the financial institutions, we talked about that on one of the last podcasts, right? Get a low rate. Take an adjustable rate mortgage, and you have a 5-year ARM or something like that, and then the rates go up 5 years from now. And when you could have locked it in and had it locked in for the full 30 years. You got to think strategically. You got to think through the big picture. Where am I going to be? And most people that I talk to, we think we're going to be somewhere, and then we end up somewhere else. And it's usually something. It could be better, could be worse. But the idea is that optimizing the mortgage interest deduction could not only impact the AMT, but it could also have a dramatic impact on the taxation. And we created a summary on the guide using this $400,000 a year person with a $450,000 mortgage. And we just kind of ran through it. And what we saw is not only without optimizing the interest deduction, the person has AMT. When you optimize the interest deduction under the new tax law, the AMT got washed out. So it was adding like $4,000 of mortgage interest to your bottom line, saves $6,000 in taxes. It's unbelievable. So these are things, that's for this hypothetical situation that I created for the individual, right? Your circumstances are different, but this is what we're saying is you need to know if you do this, and we're not doing mortgages. So that's not one of our, that's not part of our business, but we want to make sure that you optimize that mortgage interest deduction for the entire time frame of the plan. Then we walk into, the impact of tax deferral. And the takeaway on this for this $400,000 person, and we assumed a solo 401k, maximum deduction, 50-something thousand dollars. The deduction on the old bracket is close to 46%, I think is what we came up with, 42%. And with the new structure, it's down to like 36%. And the sole purpose of tax deferral is to convert from a high bracket to a low bracket. Right. If I go from a low bracket to a high bracket, this is what I say every day. It's 1986, and the bracket just went from 50% to 28%, top marginal bracket. And I deferred a lot of money at the 28% tax bracket in 1987, and I'm taking it out now in the 37% tax bracket. Do you think that benefited you? If you do the math, it most likely does not, unless we can get it out in a more tax advantage way at a lower bracket. So you really got to think through this. And then the final section is I am giving some very key things on how to grow your business, but doing it in multiple factors, right? So that if I have a business that does $3 million in sales, and I sell 10,000 units at $300 each, just that simple math, right? There's my $3 million. And I increase my price by 1%. That adds $30,000 to the top line. And that has no impact on my cost of goods sold.
Right.
So in my conversation, it's change this by 1%, modify this by 2%, change these. There's basically there's like 7 different things that I'm walking the people through to get to the bottom line, reduce expenses by 5% here, do this here. And what you end up doing is picking up over a 25% increase in the amount of income that you're generating from your business. And this is, I do this every year in my own business, these simple steps. We try to work on our marketing. We try to make sure that these metrics are constantly being done. But my reason for focusing it on the Small Business Owner's Guide is this is the time when if you have QBI, if you have $300,000 of QBI, there's $60,000 not getting taxed. I want to make that bigger. That's not getting taxed. Right. And that's the power of this thing. So we're so excited by this tax law. And it also, if you're not self-employed and you work for a corporation, there's tremendous benefits for you too. We got excited on the QBI because that's where the biggest deduction is. We're going to put together another guide for the individual who's the corporate executive, the Wall Street person, executive, the stock options, because this is one of those tax times too, where deferred comp and things like that are being deferred, and you have an opportunity to change how you're going to receive that money, and you're close to retirement, it might make sense to accelerate those in this tax law for the next 5 to 6 years. So this is not just simply isolated to the individual. So in summary, right, as I sit back and I think through this opportunity, download the guide, get the full story, attend a webinar where we're actually going to walk through these components on the webinar in detail. If you're interested in getting your own individualized, no obligation, evaluation, we will set up that 30-minute call. We'll have that conversation with you. We'll walk through your plan, and we'll get a good indication of, we can help you or we can help you. Or you might be on a call and you say, well, John's a complete moron. I don't want to talk to him.
I really doubt that part, John. But thank you for this. So as a small business owner, I want to thank you for compiling this information because and being so willing to have the conversations with small business owners to make sure that they're maximizing these benefits. This was a big change, right? As you know, and you've said, because we've done with 3 podcasts on this now since this happened. And your willingness to hold these free events, everybody who's listening, free events to be able to sit down and learn more about not just these maximizing benefits, but also if you can't tell, John's passionate about this, and my experience has always been I want to seek out those very passionate people who really love what they do because it changes the way the whole system works, and you generally get a much better product at the end. So, John, anything you want to say before we wrap up today's podcast?
This is an opportunity that if you wait, I think you're going to lose hundreds of thousands of dollars in opportunity costs, and I think this is a perfect example. If your advisors that you're talking to don't really have a handle on this, why they might be great people, you need to really get out there and seek some new people.
And with that, make sure you go to the website, which is, what is it again?
Smallwoodwealth.com.
Smallwoodwealth.com. Make sure you go to the website, and that way you can download the white paper and also have an opportunity to sign up for the educational event. So for John Smallwood, this is Matt Halloran, and for all of us here, we really want to thank you for your time today. And if you haven't subscribed below, this is the time to do that because you should be sharing this podcast and this white paper with anybody you know who owns a small business because this is the time to take action. So with that, thank you very much. We'll see you on the other side of the mic very soon.
I just want to add one more thing.
Yeah.
While it's a white paper, it's colorful.
It's really a visually appealing white paper. I will agree with you on that. So, all right, John. Thanks, man. Yep, we'll see you guys soon. Bye.
Smallwood Wealth Management is a registered investment advisor. The opinions expressed by Smallwood Wealth Management and guests on this show are their own. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only. Moreover, no listener should assume that any discussions or information presented serves as the receipt of or a substitute for personalized advice from Smallwood Wealth Management or from any other investment professional and is not intended as an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Smallwood Wealth Management is not a law firm or accounting firm, and no portion of this presentation should be interpreted as legal, accounting, or tax advice. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation.